Hi, and welcome to Jankensgaard on Risk, the YouTube channel dedicated to the theory and practice of risk management. From the Frontier section of this YouTube channel, we look at interesting theories and findings to emerge from academic research on risk management. And in this video, we're going to have a look at one of the most influential theories of them all, the underinvestment theory. And we're going to ask the following questions. Do derivative cash flows really support corporate investment, as this theory poses? And you'll find more on the underinvestment theory in my book, Empowered Enterprises Management. There's also more information on my webpage, riskbudgeting.se. And as I say here on YouTube, please like and subscribe. All right, so this research here is recently published in the Journal of Banking and Finance. The paper is called Derivative Cash Flows and Corporate Investment. And it's authored by yours truly and Reda Morsley of Lund University. So the underinvestment theory of corporate risk management was published in 1993 by Froot, Sharfstein, and Stein. And it outlined a logic that explained how corporate hedging could be used to enhance the value of the firm by mitigating the underinvestment problem. And it has turned out to be one of the most influential theories in corporate risk management, perhaps the most influential, at least if you go by the volume of academic research that it has generated. But it has also served as an important practical framework. It really has some serious and important practical implications. However, it has not been tested yet using data on derivative cash flows, and derivative cash flows have a central role in this theory. But it's not until this research that this actually has been implemented. So some important questions remain unanswered then with regards to this theory. And to explain what the theory is all about, we have to understand the crucial role that internal cash flows, the cash flows generated by the operations, the business, from the business itself, throws off certain cash flows, and those can be used to reinvest. A portion of those are reinvested, and perhaps some portion is paid out as dividends. But it's a central source of finance. And these cash flows are volatile because business cycle goes up and down, and the firm strategies are their fortunes change over time. So there's volatility in corporate cash flows, right? Which means that because it's such a central source of financing for investment, there will be, either fluctuations in the amounts of externally raised funding to compensate for cash flow shortfalls. Then, so the external funding compensates for or makes up that funding gap, right? Or you have to adjust how much you invest. I mean, if you don't have the money, the financing for investment, you may have to cut back on investment, right? So too much volatility in corporate cash flows will have to mean one of these two possible outcomes, give or take some changes in the cash position, which I think they have managed to leave out there. But anyhow, the central observation is that costly external financing implies more volatility in investment. Which of these two that happens ultimately will partly depend on how easy it is for the firm to find external funding in the capital markets. If it's very easy to go, just ask for some more loans or some more share capital, then maybe you don't have to cut back on investment so much, right? But if you're financially constrained, in contrast, then a much more likely outcome is that you will at least partially have to adjust your investment program, and that may not be desirable, because what if these investments are actually good? You believe they create value, and you would like to undertake them, so as to create a shareholder value, right? But the funding is not there for it. So then it's a negative consequence from the point of view of shareholders, right? And this is what leaves a role for risk management then. So hedging in this theory is about using, coordinating financing and investment to see to it that there are fewer instances where you fall short of the amount of funding you need for investment, so that the investment process can continue undisrupted. And the idea is that cash flows are engineered or managed in such a way to make them available when you need them for value creating investments, so that you take the edge out of these financial constraints. You avoid having to, find yourself in situations where you would like to raise money externally, but you can't. You're considered uncredit worthy by market participants, and they're not willing to hand you any money. I mean, there are many reasons why the financial markets are not perfect. I mean, we have information asymmetries and conflicts of interest that make capital markets suspicious of firms who approach them with a proposal to raise funding, right? So maybe there's a debt overhang in the balance sheet already. They have no collateral left. All these things make writing new financial contracts difficult. And you might find yourself financially constrained, meaning that the cost of external financing is either, excessively high, or you can't borrow at all. Your credit ration. Then it makes more sense than before, to manage your internal cash flows through risk management, which is the point then of this theory. What we're saying here is that at present, we know remarkably little actually about whether derivatives actually play this role. I mean, risk management in this theory is understood as financial derivatives. That's a proxy for risk management used here. So there has been plenty of academic research, best described as mixed. There's no real clear, convincing, definitive evidence as of today, either showing that risk management does play this role or it does not. There's no sort of clear, winner in with respect to that question, and so it's mixed at this point. We have a few indications that hedging is related to corporate investment rates, and some that it doesn't seem to have any major role. So we haven't been able to conclude. So we're saying that this very influential theory on which so much of the discussion around corporate risk management is built in academia, it's not really it hasn't been corroborated by research at this point, despite the vast number of papers written on it. And so we would like to make some progress here. And our argument in the paper is that perhaps this has to do with how the theory is normally tested. Maybe there are certain weaknesses in that empirical design that we can improve on to have a stronger test. And the typical way to do this is to correlate somehow investment intensity, like the rates at which CapEx, capital expenditure, is growing, and the hedge ratio. So the hedge ratio stands in for risk management here. And that's how we measure it empirically. So we get some data on hedging volumes. I mean, the number of financial derivative contracts outstanding in this firm. And we take that as we divide that by the exposed volume. And that gives you the hedge ratio, the fraction of volume that is hedged. So if you're an oil and gas producer, then that could be translated into the number of barrels of oil hedged out of the expected production, also in terms of barrels of oil, right? So even more concretely, it means the number of bought put options and linear hedging contracts, such as forwards and futures, divided by your expected production in terms of barrels of oil. Because these two derivative strategies are essentially risk management from the point of view of a producer. So they mitigate downside risk, essentially. They give you protection against further falls in the oil price. So they count as risk management. So you sum those up and divide those by the number of barrels you think you're going to produce. So the point is that this hedge ratio calculated this way is an unreliable predictor of derivative cash flows, because the ultimate variable of interest is, the kind of cash flow you can generate from your derivative portfolio. And there are several circumstances that affect these derivative cash flows, but that fall outside the hedge ratio calculation. So, for example, these options and linear contracts are not completely comparable in terms of their hedging intensity. So if a put option is far out of the money, meaning that it has a strike price well below today's, the current spot price of oil, that's a different hedging intensity compared to a linear contract where you locked in the forward rate, which is presumably much higher than the strike price, and will start providing cash flow protection much sooner. So you have that issue. We know that in some cases there are margin calls on unrealized gains and losses related to a derivative portfolio, and those may imply cash injections or cash withdrawals from a trading account. So that to deal with credit risk in this deal, the counterparty may require you to set aside collateral to support unrealized losses, and that has cash implications. And you may choose to prematurely liquidate the hedging position if you're cash strapped, or you're, for some reason, you want to sort of go to the bank and say, look, we want to settle this contract already and receive the gains. So you agree on the terms for that, and that's perfectly possible in many cases. So that generates an immediate cash effect from the derivative portfolio. It's also known that many firms take simultaneous short positions. They sell options to finance the purchase of a put option, for example. So obviously these short positions are going to be cash effective in many scenarios, but they fall outside the hedge ratio definition. So for all these reasons, the classic hedge ratio is a flawed measure of the hedging intensity in firm and the actual derivative cash flows that are resulting from the firm's portfolio of financial derivatives. So we're positing here that we can benefit from measuring hedging risk management in the same unit of analysis as investment, which is US dollar in this particular case. We're looking at a sample US firm. So if at the end of this, the financial hedging policy is going to generate cash flows when we most need it, and sort of coordinate investment and financing policies, well, that is ultimately going to be about actual cash flow. So those are the ones we should measure. Meaning we have to go hand collect data. It's not served up so neatly, unfortunately, in databases. So we have to read through actual financial reports of all these companies. It's quite a bit of work, and not always the best fun, but somebody has to do it. So here we find, in this text, for example, that this company generated revenue here from the settlement of hedges, really amounting to some $5 million in this particular year. So we code that. That was referring to 2004, so that gets coded as 5.261 here, this amount. And then we repeat this for all the years throughout the sample period for a whole bunch of firms. And go figure. So there's another example where they state what the realized component is in these the gain and loss related to the derivative portfolio, and we're collecting, of course, the cash effective part, the cash settlement, because that's the derivative cash flow. And we ignore these unrealized gains and losses, except we do incorporate them as controls in later parts of the study. But all right, so we have a model then. We have the data in place, and now we need to design a model, which is going to try to explain capital expenditure, which is corporate investment, as a function of this variable here, Tobin's Q, which captures investment opportunities. The larger the Q, the more attractive the investment opportunities, presumably. So we would expect capital expenditure to be high for that reason. So operating cash flows are in this model. We're talking about operating cash flows excluding derivative cash flows. So we have sort of filtered that out or corrected for that. And this is the traditional model in this literature, where maybe I should turn on my spotlight here. All right, so this is the classic model relating a cash flow variable to capital expenditure. The idea being that this is some measure of financial constraints. The more dependent you are on operating cash flows, the more financially constrained you are. It was believed at one point, but it's a highly debated issue actually. So we're not going to get into that. But here we have a derivative cash flow variable then, that is new in the model. It hasn't been examined this way in empirical models prior to the studies. So this is a novelty of a paper. So we're expecting this to be a positive and significant number then, if cash flows are important in terms of supporting capital expenditure. That would be the hypothesis. Yeah, so that's the main variable of interest here. So we're saying that yes, derivative cash flows ought to have a positive influence on investment. And we are also expecting this to be an even stronger effect in firms where the leverage is high. And the logic for that is that high leverage implies a large cost wedge between internal and external sources of funding, so that it becomes harder to borrow essentially when you already have lots of debt. And we would also expect it to increase in times of sharply rising cost of external financing. So when overall the cost of financing is higher, we would expect internal cash flows to be, relatively speaking, more important, right? So we analyze the data and we find certain indications here that hint at important relationships already. So, for example, the correlation between derivative cash flow and operating cash flow is minus 0.44. So fairly reasonably strong correlation, a negative one, so that derivative cash flows are indeed going up when operating cash flows are going down. So that would be consistent with the risk management interpretation of corporate derivative portfolios, right? So, and the median derivative cash flow to capex ratio is 20% during industry recessions. And this means that out of the company's entire capex budget, some 20% came from derivative cash flows when the industry is down on its luck in one of these recessions, right? When the oil price tanks. And the mean is even higher, 50%. Now the mean is impacted by outliers, so we'll tend to skew it in one direction here, but it tells us that for some firms, it was a very large fraction of overall investment. Like the majority of funding for capex programs came from there. So for a non-trivial amount of firms. And the industry recessions we're talking about are found here. You know, when the oil price, after a long increase here for many years, it was the boom of the early 2000s, and then it tanked. Some better times here for a number of years, and it tanked again in 2015. Or late 2014, actually. So there are two very sharp industry recessions within our sample, in which the industry experienced lots of distress, and these were hard times, you know, to be an oil and gas producer. So good or excellent even laboratories for investigating the importance of financial derivatives and their associated cash flows. So here you see how they shoot up. This is the ratio of the derivative cash flows to assets, the median of it, and they're at their highest exactly in these industry recessions. So meaning, you know, the relative importance of derivative cash flows increased markedly in these episodes. So that is aligned with the theory. This is some early support for the theory. And then if we look at these regressions, I mean, we start with a simple model excluding derivative cash flows as typically estimated in academic research. We add derivative cash flows here, and then we add a whole bunch of other controls, which are substitutes for derivative cash flows or hedging, because they are alternative forms of risk management, like leverage. If you rely on low leverage, you have you know, access to more spare borrowing, presumably, and if you have a cash position, that could also help you out when you're in trouble. So we control for those. So the impact of derivatives is understood as holding all those other things constant, right? And we're finding that there's lots of stars here and a positive sign as expected. So the stars indicate the statistical significance. The more stars, the better. So when you include all the controls, we have some statistical significance, and it's close to 1, which is a remarkably high number. And it's tells us that for on average, you know, $1 more in derivative cash flow translates into almost $1 more in derivative, in corporate investment. So that's an economic significance. It's not just statistical significance we're talking about here. The magnitude is such that it implies real, economic significance. And we repeat these regressions, the one with all the controls for a subsample, which is above median in terms of leverage. So presumably the cost of external financing is higher for this group. Below median, they have more spare borrowing capacity, and we think then better access to financial markets and a lower cost wedge on external funding. And indeed, derivative cash flows have a much more important role to play in highly leveraged firms. So the ones consistent with the theory, because it's built on this notion that the cost on external financing provides a role for risk management. Right? So we're finding some evidence in support here also. So we conclude then that there is a consistent, we do other analysis as well. There's a whole range of different tests in this paper, and all of them point to the same conclusion, that hedging does support corporate investment in this particular industry. Right? So there's a statistical and economic significance to this, and more so in highly leveraged firms. And during these industry recessions, when cost of external financing goes up, derivative cash flows appear to be very important in terms of sustaining investment programs and thus helping to preserve corporate value, presumably, by not having to force large cuts in the investment program. So plenty of support for the theory in this particular paper. And yes, we were able to answer a resounding yes to that question: do derivative cash flows support corporate investment? So that's from the frontier. Thank you for listening.